Well, hey guys, I wanted to put together something as far as a video and some slides as far as the physical inventories portion, and that's what the subject is, this particular unit. And so anyway, this is what I used in my in-class version of this, and we'll try to do a good job and answer some of your questions along the line. I'm not going to cover everything, but that's why I include the text part of this. I still think that the Farm and Ranch Records book that you have available to you online is probably one of the best ones there is out there. It's not that you can use it all, it has some great examples. I know that it also is fairly old. It was written in the 80s. I had the chance to work with these couple professors that put that book together, and of course they've given us the availability of it in our course, and I'm forever grateful for that. It's out of print right now and probably will never be in print again, and it's a little bit dated, but back in the 80s, back in my day, we had to actually write everything down. We didn't have things like, actually about 1987, 88, I was introduced to spreadsheets, and those became my data compilation type of modules that I used, and I would encourage all of you to actually use those. I mean, we can cell reference, we can use those numbers again, we can manipulate them, and we can save so much time with the spreadsheet. Later on in the week, I'll try to get something posted as far as a primer goes for the Google spreadsheets. That's the way I'd like you to do the homeworks for this week's unit, and then we'll go from there. And if you have any questions about that or the unit itself, of course, you can give me a call and we can discuss it. Questions lead to questions, leads to more questions. And the reason that we're in school is not only to learn a particular subject, but is to learn how to learn. And to be honest with you, I still am. And God's given all of us a certain amount of curiosity, and usually when we start into a certain subject, we may think we know a lot about, but it usually ends up that we can learn a whole lot more. At least that's been my experience, and it continues to be so. So anyway, we're talking about these physical inventories, and we've actually kind of hit on them when we talked about the balance sheet, the income statement, and the cash flow statements. And the reason that I introduced you to those vehicles before we actually talked about these is that it's very easy to get in the weeds, and then we get lost. And so I took accounting many years ago, and it seemed like most accounting classes are like that, and it's like, whoa, my head is spinning, and I don't really know why we're here, and it's fairly complicated, or it's getting more complex and that sort of thing. So that's the reason that I introduced you to those financial statements in the very beginning of the course. So now we're going to step back and we're going to say, okay, what are the records that actually facilitate those financial statements? And a question that you should have every single time that you look at any of this stuff is, what financial statement does it affect? How does it affect that particular financial statement? And how do I perform, or what effect does it, how does it affect the basic accounting equation of assets equal liabilities plus owner's equity? That's, if I've done anything in this course, that is my hope, is that you'll actually connect those two things, because they're integral to the whole thing. Now like I said, we're going to get into the weeds here, and I want to bring you back every once in a while and say, how does that affect the balance sheet? How does that affect the income statement? Does it have any effect on the cash flow, and how? So be asking yourselves. If I don't ask it implicitly, then ask it to yourselves as we go through this stuff. All right? Well, if you're in an accounting class, we probably would start out here. And is that how do you value those things that are used up within the year or within just a short period of time? And how do we expense them out? And, you know, a multitude of questions. And these two things come into bearing and are worthy of thinking about. But since we mostly, in most small businesses, we're no different than other small businesses that are doing only $1 million, $500,000, $1 million, or even a little bit more than that. They generally operate under a modified cash system that we've been talking about that's practical and usable. Okay, and it works right alongside of our income tax records that we need to keep, because the federal government and possibly the state government actually enforces that, and they say you will have records and you will report to us. So anyway, it's nice to be familiar with these things anyway, and there's two ways that we could value those things that are in our operation so that we kind of keep track of them. One of them in a general sense is called FIFO. That's actually first in, first out. Okay, so that would be how you track that inventory. That first things that are put into your inventory are the first things out. And we're not going to go over an example here, but hopefully you can visualize that. And the other one, that's probably used more often than any other. The other one is the LIFO, is that the last in is what we take out first. Okay, is LIFO. So it's very similar, except there is definitely quite a difference between those two. You just have to be consistent. You can't just use one versus the other. Use the same one, so not only do you make it simple, but actually for accounting practices, it would just be a mess if you did anything different, if you're actually implementing these kinds of things. Okay, so that's FIFO and LIFO. So being practical, and that's what I keep coming back to in this course, is that I want to talk about these things in a practical sense. And we never get the chance to talk that way in an accounting class, it seems like. But for small businesses and ag-based operations, the value of physical inventories at the time of inventory, the date is essential. Okay? And we can do it a couple of different ways. First one that I've got up on the board here is based on current market price. Okay? And I always kind of tell people that the human brain always values things, well, not always, but most of us will say, well, this is what I heard I could get. But this market price is a little bit different than that. The way I would actually define it is a reasonable price that I could go out there in the marketplace and within a reasonable amount of time I could receive that for that particular inventory item. Whether it's hay, it's feed, it's fertilizer, it may be market livestock that you have on hand as well. So those kinds of things, be a little bit conservative, and then you can be surprised is when you value them on a market value. Hay, grains, marketable livestock, that sort of things would be some of the inventory that we're talking about. Two purchased inputs are also a portion of the inputs, and they would be feed, fuel, chemicals, and they're valued at the actual purchase price. Well, that should be the market price, because that's what we paid for them. It's probably typically not going to be much more or less than that purchase price in those particular inventory items. Okay, so my question is which financial statement, and I'm not going to answer it, but I want you to answer it, is like, where does this appear and how does it affect it? Well, I will answer it. Okay, inventory items are all current assets. Okay, so that implies that it's on the balance sheet. Okay, and I know most of you probably already knew that. So those would be listed under current assets on the balance sheet. As we sell them, they're going to have a direct impact on sell them or use them if we have to do some adjustments. Adjustments would be show up on the income statement. As we sell those, they would affect our income statement and our cash flow statements, right? Okay, so that's the kind of mindset I want you to have as we go through this material. Is what at very least is to ask yourself, what financial statement? Okay, crops and feed inventory are performed at the beginning of the accounting period, and like I've said before, typically we all have we actually have to file with the IRS and for our business, and most of us is January through December. If you've selected a different time period, that's okay. It's just that we might take a stock of inventory or a list of inventory at the beginning or ending of that period. And the great thing about actually performing a beginning and ending inventory is that we just have to do it once, because the beginning or the ending becomes the beginning and the beginning becomes the ending, if that makes sense. So on a fiscal year from January to December, if we do it on the 28th of December, that also is going to be the same inventory we would carry over for January 1st, unless we have something happen within those few days. Typically we don't, and you wouldn't want to perform the inventory if it wasn't useful in the next fiscal year until you're done. Okay, so that's one of the reasons that we perform one actually per year, and then we get the beginning and the ending. All right, so we match up with the business's fiscal year, the amount of the commodity, the value per unit, and the date of the inventory. Okay, so that's typically how we perform an inventory of those kinds of things, and many times we can be very, very accurate, and sometimes we have to actually swag it to a certain degree just to come out. It's not too easy. We can do some volume measurements on grain and that sort of thing, but we can actually come fairly close, especially once we've done it a few times, and we can estimate those particular inventories for our records. Livestock inventory, it's important to classify the livestock. What type of livestock is it? Okay. Are they steers? Are they heifers? They're going to have a different valuation for the two. It gets a little bit wishy-washy if you put them all together and you just throw an estimated value for each one of those. Breeding livestock, we've got raised and purchased that might be included in this particular inventory, and also other, and the textbook, they always put dairy in there. That's not actually in our part of the world. It might be yours, but I would probably, a better example would be like all of your workhorses. Now I say workhorses, those that you use on the ranch would typically be put in this classification. And they definitely have different values for the age, the kind, and that sort of thing. You know, a mid-aged one in its prime that's 6 to 12 years old is going to be more valuable that's one that's 15 or above, or that's two or less that's untrained. So those are some things to actually take into consideration on livestock inventories, and a little bit different classification too. Again, when we talk about those things, which financial statement does it affect, and where on that financial statement is the effect seen? All right, we've got this animal in, and this is, I've emphasized throughout the whole semester that, business is business. Don't think you're so special as far as a business goes. I know it is different in all business, in the fact that if you're passionate about it, yours is going to be different. And I get that. Mine was and is in that regard. But there is an exception to that rule that I keep pounding into your head. We're no different. Well, we are in this one aspect, is that we've got raised versus purchased market livestock. Okay, and accounting has a little bit of a trouble with this cow that is actually we're putting hay into her. We're putting her out on pasture and feeding her forage and maybe some supplements and that sort of thing, vaccinations and health concerns, putting those kinds of costs into her. And then all of a sudden, where we had one, we have two. Or, in the case of a sheep operation, we might have 2 or 3 or 4. So, and other operations, other kinds of livestock, there's some variations there. But they need to be handled a little bit different. And they need to be handled separately on your inventory, okay? Because typically a modified cash system does not depreciate raised livestock, whereas we may use or enforce a bit of, well, we've got the purchase price on any kind of livestock which we purchase. So that's how we would inventory them, plus whatever added value we actually put into them. So anyway, that's kind of the exception when it comes to that. We're going to have to deal with that when we look at fixed assets too, as far as physical assets. So again, I just had to copy this slide, but I want you to think about this. Pause the video for a second and think about how would you answer these questions. Probably we'll see these in the quiz later on in the week. Okay? So here we are at raised and purchased breeding livestock. Market-wise, market livestock, we can deal with those fairly easily, and those would be current assets, by the way, on your balance sheet. Okay, I just gave away the answer there, didn't I? When would it affect the income statement? When would it affect the cash flow would be the question after the question. Okay, raised and purchased breeding livestock, for federal income tax filings, they've got to be separated. That's actually a regulation. Valuations would be different on the balance sheet, so we have to have 2 separate lines at least if we're not aging them as well by value. Purchase breeding livestock can be depreciated because we have a purchase price. They came into the business at a certain price and will be valued as such, and we can depreciate that value or the purchase price over time. Raised livestock, we've got a year and a half, well, maybe even 2 to 2.5 years before the production out of that cow actually comes out and we can market it. Other livestock like hogs and land or sheep and goats and that sort of thing would be a fairly short production period, but similar in the fact that we couldn't depreciate them if we had not actually if we'd already expensed out everything in that time period that it took in order to raise them. Okay, and I know they're the exception. There are some ranches out there that they keep track of every expense that they put into their raised livestock, and they retain some of their heifers. They bring them back into the herd. They keep track of almost every dollar that goes into them. They don't expense those things until it's time to depreciate those livestock in that way. But I'm always looking at the more practical way to do that. The reason that we wouldn't depreciate raised livestock is if our operation does not change from one year to the next, then those expenses that we put into those breeding livestock actually are a wash. They're very similar from one period to the next is what I'm talking about. So for a practical sense, I want to get some bang out of my buck or my time when I'm actually taking keeping track of this information. And so I would not want, my time's more valuable than that. It may be that you want to do that. It's a very good exercise to know how much it takes to raise something up to productive age. And then you can make some other decisions on that. But we can typically pull information from what we're building here in order to come up with a figure like that. So, major difference between purchased and raised breeding livestock and how we would handle them. Purchased would be depreciated over their useful life, whereas raised would not have they actually wouldn't have a basis, what we call it, to depreciate from. They'd have a market value that we might want to give and keep track of, but they wouldn't have an actually cost basis to depreciate from. Okay, again, which financial statement? Where on the financial statement? And I can tell you this right now, that raised and purchased breeding livestock would be in a fixed asset category. Okay. We're going to talk about depreciation in the next unit, and you're going to get a lot of practice at it. So if you're longing for a little more information there, then we'll give you a little commercial on the next one. Okay. Now this is just one of the many forms that are included in your textbook. And like I was telling everybody in class the other day, is that, why reinvent things? I can take a look at some of this stuff. There is some phenomenal record-keeping type of data sets and go, I think I could use that. I might have to tweak it a little bit. I think I could put that in a spreadsheet and actually use those numbers. And I could have some cell reference and some formulas in there so it automatically summed up and did some manipulation of that data. And I think I could do that fairly easily. Guess what? This week you get a chance to do that. You're going to take two of these forms that are in the textbook. You're going to take and just put them right on a spreadsheet. It's fairly simple formulas that you need to put in there, and that's what I'm going to be looking at mostly. On this one, just to give you, if I were to look at this thing and say, well, I'm the sole owner, what the heck's it got landlord on there for? Well, I'm going to take those columns out. Okay, so don't let it mix you up. Just say, well, I do lease, and it is a share basis that I have a landlord with, so I need to track this. So this would be a fairly complex type of an arrangement, but a normal arrangement in something that we might do as far as livestock share with a landlord type of thing. But so livestock, or actually this case, this is a farming operation here. So anyway, if you have any questions on this week's physical inventories, it's all about that. It's all about what financial statement does it affect and how does it affect it. I'll talk to you soon. And if you need a little bit of help with spreadsheets or any questions on this material, let me know.